2025 was the year emerging markets made a comeback, but can it carry on into next year? This is Sectors Up Close, and we're talking emerging markets. A year ago, one of the hottest topics with investors was how to diversify away from the US, as they feared unstable trade policies and sold out of the dollar. The US economy and Wall Street equities have defied those worries, but that hasn't stopped money pouring into emerging markets. MSCI's Emerging Markets Index is up 26% for the year. Stephen Schoenfeld is CEO at MarketVector Indexes. Stephen, let's start with China here. After a few years when Chinese equities were very unfashionable with foreign investors, they have made a comeback. So what's driving that?
So there are a couple of factors. They started the year still a little bit weak, and with all global markets had a weak spot in April. But the DeepSeek announcement showed that they were real players in AI, gave a shock to US tech companies, and then a number of initiatives by the government for reform to help stabilize the real estate market and encourage investment have continued to power Chinese equities, and now foreign investors have started allocating again.
Does that mean that China needs to keep showing very rapid progress in AI to keep foreign investors interested?
I think they need, first and foremost, stable, predictable policies that foreign investors can feel comfortable allocating to China. There have been situations in the past where they've changed their direction. We will see, of course, developments and a kind of race in AI between the West and China. So anything positive from China will help. But we will see the return of the Chinese retail investor too, as their household balance sheets improve.
Now, the manufacturing chain for AI is also mostly in Asia, notably chip making in Taiwan. Those companies have performed very well. Could that change next year? Will efforts by the US administration to move the AI production chain to the US make them less attractive?
Well, the major Taiwanese and Korean semiconductor companies are all involved in the US initiative, and the US views them as allies in the overall race against China. So I think they will benefit, these companies, whether they're manufacturing in the US or manufacturing in Asia. And also, we can't forget the technological prowess and the sheer capacity that's there. That is not going to go away. That will only become more important in 2026.
Going forward then, Stephen, one of the things that's helped drive emerging markets this year is weak US dollar performance and investors looking for better performance elsewhere. Will that continue?
Well, all signs are that the dollar will be flat to weak going into the new year. There don't seem to be any policies coming out of Washington that will change that, and the Fed is on a gradual easing pace. But more importantly, emerging markets started the year with very low valuations relative to US equities, and even after outperforming, almost doubling, they still have significantly lower valuations. The price-book ratio is about 2 compared to almost 5 in the US, and the PE ratio is about half of the US as well. So that fundamental attraction, if the companies can keep delivering, will absolutely, I believe, encourage more allocations to emerging markets.
So where should investors be allocating? What are your key markets to watch for next year?
So aside from having a broad exposure to emerging markets, because there's always surprises, I think the market we are most excited about is India. India has basically not performed this year. It's kind of flat. A few sectors have done well, but the Indian macroeconomy is in a very strong position. Interest rates are easing, and the companies are poised to deliver more earnings. So we would encourage an overweight in India. Second, I would like to highlight a country that's not yet officially emerging markets, but treated as such by many, and that's Vietnam. Vietnam delivered over 50% returns this year. Our Vietnam local index includes Vietnamese stocks primarily listed in Vietnam. And in the fall of 2026, Vietnam is going to achieve something they've been gunning for a long time. That is graduation to emerging market status in the FTSE benchmarks. And we believe that will follow in other countries. Our broad emerging market index already includes Vietnam because of those reforms. And I think that's a place that investors should look.
Investors did see Vietnam as one of the countries that might suffer the most from President Trump's tariffs. Does this mean that these Southeast Asian countries that were very reliant on the US export market have managed to get around that obstacle?
They have been reliant, and they still are reliant. I wouldn't say they've gotten around the obstacle, but they're working through it. So combination of manufacturers, distributors, and the end retailers are compressing their margins so as to maintain the share. And some manufacturing is being moved to other Southeast Asian companies. But Vietnam is also a domestic story. It's a very positive demographic, a young country. So there's a lot of good things happening in the local economy that makes us bullish.
That was Schoenfeld of MarketVector Indexes. Don't forget you can watch more videos on Reuters.com.